Good afternoon, good morning. I'm Simon Duke, Managing Editor at Expana. We appreciate you making the time for this exclusive webinar. Our aim today is to provide some clarity amongst all this geopolitical stress and market volatility. So the Middle East conflict is now in its fourth day. A lot has been going on, and I've had to constantly update my introductory remarks. I'll get to them shortly. But first, I'd like to introduce my colleagues joining me on the call. We have Andrew Woods, Senior Market Reporter, Tosin Jack, Director of Market Reporting, and Tom Bungard, Vice President of Price Forecasting. Thanks for joining me today. As we know, the hostilities have intensified. Israeli forces are conducting continued strikes against Iranian-linked targets and armed groups across the region. In Lebanon, clashes between Israeli forces and Hezbollah have increased sharply in both frequency and scale. Iran has responded with a series of drone and missile attacks targeting US military facilities and allied infrastructure in Gulf states, including Oman, Bahrain, and Saudi Arabia. Even Cyprus has been targeted. But here is where it becomes a global concern. The Strait of Hormuz. This waterway is critical to world energy security. Roughly 1/5 of global oil and significant volumes of liquefied natural gas, LNG, transit through it daily. And right now, it's become a flashpoint. Iran has threatened to target any vessels attempting passage. Commercial ships and fuel tankers have reportedly been struck by drones and projectiles. As a result, traffic through the strait has sharply declined. This is triggering immediate shocks in global energy markets. Qatar announced yesterday it suspended LNG production following a reported Iranian drone attack on one of its facilities. A prolonged shutdown or damage to LNG infrastructure could trigger a major gas market shock. Qatar transports 90% of its LNG exports through the strait. 1/5 of the world's LNG goes through that same corridor. We're starting to see some supply chain responses. For example, Indian authorities announced today they're reducing natural gas supplies to industries in anticipation of tighter supplies ahead. Meanwhile, the shipping industry is taking evasive action. Major carriers have suspended or reduced transits through Hormuz. Vessels are being rerouted around the Cape of Good Hope, a diversion that adds weeks to sailing times, increases fuel consumption, and significantly raises operating costs. Beyond cargo, there's damage to port facilities and coastal infrastructure from missile debris and maritime attacks at major commercial hubs. The bottom line is, Asia and Europe face substantial disruption if the Strait of Hormuz remains closed and energy infrastructure continues to be targeted. At Expana, we're monitoring this situation very closely and bring you updates as they develop. I'd like to ask you, Andrew, about your views of what's going on.
Brilliant. Thank you very much, Simon, for that introduction and what's been going on. A very somber time, of course, with this Iranian conflict involving the US and Israel as well. I think really what I would say here, it's a seismic geopolitical shift. It really is. And I think we can't underestimate this. It's very easy to forget what's happened even in 4 days, I would argue, because so much has happened. The supreme leader of Iran has been killed. This is simply unprecedented. And it's really got absolute shockwaves throughout the whole world. So I think the first thing I'd touch on is that fact. It's seismic. The wider retaliatory measures as well. Really, really important. The United Arab Emirates, Bahrain and Qatar being targeted by Iran. And I think at the moment we've seen primarily military targets in progress, as one would expect early in a conflict. But it's really going to be critical to watch if this spreads at all to other kind of infrastructure. And I think it's also another question geopolitically, Simon. I wonder your thoughts on this too. Who else joins this conflict? Are other major powers going to become involved? Is it going to really grow? It's really an interesting point, I think, to consider. I think in terms of the actual market shock here, as you touched upon, the oil and gas markets, that is really a critical part that we've got to focus on. I think looking at price action, even just yesterday during the day, we've seen natural gas prices in Europe up 39% in one day. We've also seen Brent crude up 7.3% in one day. These are real shockwaves, absolutely incredible price action that we're seeing here. And as you mentioned in the introduction, the Strait of Hormuz, absolutely pivotal to the transport of crude oil in the region, of natural gas as well. And as even 20% of global crude production flowing through that area, and similar levels of LNG. So when we've realized that actually the Strait of Hormuz is effectively closed, that has an absolutely, catastrophic impact on supply chains, as we are seeing at the current time. Brent crude has continued its move upwards today. So I think what we are currently monitoring is, where do we go next? Where does the conflict go next? Are we going to start seeing the impact on energy infrastructure? And I think there are a few clues that actually this is starting to take place. So what we've seen, an oil refinery in Saudi Arabia, there were drones sort of censored around that area. A fire broke out. I believe this was yesterday, and it's apparently under control. But it is the first clue that perhaps this is the next stage from what the sources tell us. Furthermore, as you also mentioned, we've got the Qatar situation. Qatar Energy has shut off LNG production now. Qatar is a major player in the LNG market, exporting massive amounts to Asia and Europe. And I know from talking to people in Europe, in downstream industries, the container glass industry, for instance, very energy intensive industries, they're incredibly worried about the impact of this development on their processes, on their ability to procure natural gas. And what we saw, if we can look back to the Russia-Ukraine war for a moment as well, we saw that shock in prices. We really did. And we're seeing it again in this situation. As I mentioned, 39% increase in prices yesterday. So this is really a very difficult problem for these downstream parties to be dealing with. And I really think that there's other news coming out, is very rapidly evolving all the time. And we've also heard news recently, the US believes there's an imminent attack on Dhahran, which is a very important oil city in Saudi Arabia. So it's going to be very, very important to monitor crude oil price action in the coming, I say hours, perhaps it's a case of minutes actually at the current time. Things are moving at such a rate of knots. But for sure, I would actually argue yesterday that the 7.3% increase in crude oil, it sounds strange to say it, but that actually felt quite muted from what I expected, and from what the sources expected. Because this is, as I said, this is seismic, this is unprecedented. And in such a sensitive region for energy, a lot of sources anticipated much, much higher moves up. Now, they now believe that if the infrastructure and the energy infrastructure starts to get targeted, that kind of situation could take place. That's what we hear from the market. I think the other factor in all of this really revolves around shipping. You mentioned the Strait of Hormuz, and what we've heard, carriers just not moving through those areas anymore. They've had to reroute, and shipping rates are going up massively as a result of this. The rerouting around the Cape of Good Hope, as we saw during the Houthi attacks in the Red Sea, for instance, really increases freight rates. It increases transit times. It causes major delays, and actually results in a shortage of ships as well. So it really makes transporting goods incredibly difficult. As Tolson will touch on later on in more specific commodity markets, I was talking to some soda ash market participants this morning who are based in China, and they're already saying that their prices are really starting to shoot up, because the export market has suddenly, almost overnight, become a very, very difficult area to traverse. So their ability to ship into Europe has really become very, very limited. I think that the rates continue to climb. In terms of the oil market, players are perhaps looking at different origins that they can source from, perhaps Africa, excuse me, and that is something that they're exploring. And there's also some pipelines that can be utilized, Saudi Arabia, United Arab Emirates. But the simple fact is that this cannot replace the Strait of Hormuz. That being taken out of action is really a critical blow to the oil market at the current time. It's a real crisis situation, and I think other sources are also worried about the potential spillover of this conflict. If it is indeed contained in Iran and the surrounding Gulf states, or does it spill over to the Red Sea as well? That's a real worry, and they think that would just make the situation even more difficult. So this is what we're really seeing at the moment in the energy and shipping markets. A lot of volatility. You'll notice I've had no slides today to present from because they're really it's the fog of war. It really is, and clarity is difficult to come by at the current time. But we're doing our very best to get that information to hand. And I think that we certainly can put the price action together with the geopolitical events, the real seismic nature of what's been going on, and assess that it's a very, very difficult time at the moment within crude and gas. And I think that the initial market shock we can see on the price action, what we really are looking out for as well is the downstream impact. There's so many industries downstream, as I think will be touched upon, the plastics industry, for instance. Crude oil is so important for that production process, which we may only see further down the line. So it's what goes on with this. A lot of people I've been speaking to as well, worried about the impact potentially over the long term on inflation. We see how energy and food is so important in creating that headline inflation figure. These prices going up, they really think that even after a deceleration in inflation and a cutting of interest rates, they believe that problem may be back further down the line. So all these factors, it really isn't limited to 4 days of war. It's what comes after that, I think, is the key message as well, further down the line, which we may be unable to see just yet, Simon.
Yes, I really appreciate that overview, Andrew. Very, very rich information. Tosin, Andrew mentioned that you've been making some observations with regard to some commodity markets that we're tracking. Would you like to provide an overview of those?
Yeah, that's great. Thank you, Simon. So yeah, as Andrew and Simon have mentioned, the key thing is it's evolving, it's changing. But we're already seeing some price impacts on some specific commodities so far. So I'm going to touch on those very top level, just give you insights into what we're seeing so far. But the key message is that this keeps changing. The main issue has been, as Andrew mentioned, energy and shipping issues. So what better market to start with than soybean oil? Soybean oil is a market that is positively correlated with crude oil, such that when we have higher crude oil prices, typically they drive the demand for soy-based fuel. So yesterday, we already saw that the Chicago soybean futures surged to their highest level in more than 2 years, mainly driven by sharp rise. And right now, currently, the spot prices for soybean oil, the last time we saw this price was in 2023, thereabouts. So it's just showing you that we're already seeing that big drive. So what you expect is that you just keep an eye on this soybean oil price. It will be driven by energy prices. This price was also already being driven by the biofuel mandate. So very energy driven market. So soybean oil is one that's seen great impact and one that we should continue to watch out for. Staying in that oilseeds and grain sector, look at the grains market. We've already seen wheat and corn futures on the Euronext and CBOT. They moved slightly higher yesterday as well, with traders reporting that they're already building in a risk premium due to this geopolitical uncertainty. To put it in context, the Middle East absorbs about 12% of global wheat trade. So it's a very key market for exporters. And sources are then anticipating that this ongoing conflict may disrupt import flows in the Middle East, either physically blocking the passage or reducing import volumes altogether due to insurance costs and various things like that. So in the short term, sources expect that affected importing countries will rely more on stockpiles to maintain supply. And traders have also said to us that they don't expect the grains market to see that sharp rally in prices. They're just really expecting that it will gradually go up, but this is what they're saying to us. It's a similar fundamental story for corn, so I won't spend too much time on that. But also, the region also accounts for about 18 to 20% of the global feed barley demand. and roughly about 35% of barley imports. So it's also a dominant force in this market. So another market to watch out for is this grains market, just because of just the mere significance of this Middle East region on trade dynamics. I'm going to stick to the feed, raw material, and ingredient sector. We've also seen that the conflict is already impacting the global feed additives markets. This is mainly due to the shipping disruptions. And we're also seeing that the raw material markets that drive methionine production strengthened this week, also supported by rising crude oil, sulfur, and methanol prices. And overall, all these are increasing the upstream costs for chemical synthesis, including propylene. So staying on the feed additive space as well, we've also seen increases in vitamins and feed-grade phosphate prices from China because of the conflict. So I'm going to naturally then move on to the protein sector, where I've just talked about feed. For the protein sector, where feed is a key input cost, I think a key market that we've seen impact so far is the dairy sector. But something with the dairy sector is that the impact didn't just start. Market participants have said that they already started reacting since the beginning of the year because they were taking advantage of a 5-year low skimmed milk powder prices. And so this is because the price were low, so they were already using dairy products as security stocks. And we saw that Expana benchmark prices for EU skim milk powder, for example, increased by almost 23% by the end of February, right, when you compare it to the beginning of the year. And what market players said to us at this time was they were just citing geopolitical turmoil in the Middle East as a main driver. Now, why is this the case? It's because Iran is now the 4th largest skimmed milk powder exporter. And markets around the Middle East region also relies on Iran due to the shorter transit and kind of competitive prices, right? So the dairy market, mainly the skimmed milk powder, is also one we're already seeing a reaction, and the market is also kind of overall keeping an eye. Moving on quickly and staying in this protein space, we've also touched on the seafood market. The main concern is the halt in shipments. This is impacting transportation of highly perishable goods in the seafood sector. So what market players have said to us is that they're just mainly warning that these short-term hostilities could suppress Middle East and North Africa imports for weeks. So it just highlights that this geopolitical instability can quickly reshape global seafood supply chains. Quickly on the red meat sector, staying on that protein space, it's really a watch and see, like most other markets as well. We're waiting for the data to come in, but market players are watching closely. And it's really the expectation is that freight and logistics will continue to emerge as the main pressure point across the sector. So summary for that protein space and some of these markets that are already seeing is that some prices we're already currently seeing some price reaction, some price impact, but they're also watching, paying attention. But key drivers will be the shipping, energy, and also especially for energy intensive markets. So those are mainly the food categories. We've also seen some movements in the nuts markets as well in the US, but they're also taking a wait and see approach. So it's very important that we stay on top of the data, stay on top of the insights, stay on top of the intelligence as this is evolving very, very quickly. I'm going to do a deep dive into the non-food markets. As Andrew mentioned earlier on, energy prices are already impacting plastic prices, being a key production cost driver. We've also seen price increases. We've also seen price impact in glass and soda ash, as Andrew mentioned. But overall, what sources are saying to us is that they're anticipating short-term impacts due to the fact that these products are energy intensive. So again, energy, keyword, energy intensive production. Lastly, another market that we're watching very closely and that we want to bring your attention to is sulfur. Sulfur is very important for fertilizer production. It is also used in the animal nutrition sector to make feed phosphates, which I mentioned earlier on to you that we're already seeing feed phosphate prices increasing in China. Sulfur is also very important for mining, for the metals, pulp, paper, rubber manufacturing. So the whole non-food category. So it's something we're saying keep an eye on. We're still watching it. Overall, why is this the case? It's because we're already seeing impact on refineries, and this is already causing concerns for sulfur production. So any kind of reaction or impact on production, sources are saying to us will have an impact on prices and then have that double whammy effect on all these other usage, all these other categories that use this material. So beyond the short-term impact of the conflict, which this webinar focuses on, my key message is that it's critical that we stay on top of market dynamics, stay on top of the fundamentals, and stay on top of some other price drivers. Right now, the conflict is taking attention, but it's very important to have a holistic view. You need to get a comprehensive overview of the market movements. Some markets are already tightly supplied. Some meaning that the impact of any further disruption can be felt more quickly than in well-supplied markets. So a key message today is that it's not just this one thing. It's really having that comprehensive view, having access to the data, having access to the information, and staying on top of market trends and dynamics.
Thank you very much for that, Tosin. It's fascinating to see how everything's so intertwined. I'll move on to Tom now. And briefly, Tom, I know you've got a bit of a case study in mind, but from a forecasting perspective, what can you share with us today?
Well, I wanted to share a little bit of forecasting just on one commodity, on Brent oil or crude oil. It's just because we forecast most of them, but the highlight of this conflict is crude oil. So let me show you the forecast. Normally you have to be a client to see this, but we thought in the light of what's happening, it will be good to sort of just share it openly. So let me show you my screen so you can see that. This is our forecast for, here we go. This is our forecast for crude oil. We haven't changed it, by the way. It's been like this for many months. 15 is the low point, and we expected a 16 up to here with a Q1 peak of 82. What you can see is prices hit 78 yesterday, but I just checked half an hour ago and it was at 84 today. So prices are really, really going up, actually above our 82 mark. The idea behind this was we were expecting, sort of a big supply disruption. We said this is our primary thing. We didn't know about Iran. It could be any kind of supply disruption. So this was our main scenario. We had a secondary scenario with a somewhat of a smaller increase, but without any supply disruption. But what we're seeing is what I think this is the panic phase. And we've scheduled this to last into March, maybe some weeks more. But that's the panic phase where everyone just jumps in and does stuff. And that panic is just affecting prices very, very much. Then we think there's going to be a slight pause into Q2, which is just the market stepping back, trying to evaluate how long is this conflict going to last. And then depending on that outcome, we still think that we might go up here to like $90, like roughly so into Q3. And that, of course, depends on how long this conflict is going to last. But there's a reasonable risk that it will go on, even if it's stopped quite quickly. What we saw from COVID is like these logistical domino effects takes months and months to solve. Even when the situation is solved, the domino effect keeps lasting for months on end until it's completely solved. So what we did, we actually said, basically back in January, said 26 is pointing to rising crude oil prices, and our hedging indicators basically suggested a very favorable market for hedging. And we said that on the 14th of January, saying, you should consider, it's a risk. And we said covering all of 26 would be, a feasible thing. So that is basically here in January, the 14th of January. So you could see that on our website. We said covering all of 26 would be, something that could be considered. We can't advise you anything in this webinar. This is a public webinar, so we can't advise you anything. But of course, you realize that if we are here right now, we are right at the peak, close to the peak of the panic phase, and then we could see a little bit of decline. And then the market will see how long this is going to be sustained. One thing we might to show you, if 18 is pointing to, let's say, 88 to 94 in Q3, it sounds like that's a very big target, but it's actually not. If we look at the key fundamentals, there's a lot of explanation to this, but this gray band is what we can consider more or less, it's a regression band, it's a fair price. What you can see, the black line is the crude oil price, and that crude oil price was very, very low, right at the cusp of being unsustainably low. And so what we typically see is, an increase to the top end of the band would still be considered business as usual, just like you saw over here. And the top of end of that band is right now pointing to $89, so roughly $90. But that's just in a normal market without any supply disruptions that we're seeing now, right? So just in a normal market, we could go to $90. This is definitely too low, the $60 we had. So an increase to the top end of the band would be normal, and maybe even what we call a bubble, where it breaks above the normal band because of the panic, right? We also saw that over here and over here. And one of the contributing factors to this could actually be speculators. Let me just show you. This orange line here is the speculators. And you've seen an incredibly low level. I've never seen speculators so low before. They're really, really low. And when they see this, you could think that they would be joining in and getting quite an increase. There's certainly room for them to increase much more. And speculators entering the market, if they smell blood in this, that could definitely make prices go up as another contributing factor, not just supply and demand, but also speculators. So we are in this market where what you can see is that the first increase here is just sort of the basics, right? This is just the basics of the first panic. And then it could basically spread until Q3. So that's just a very short view. We have tons of more evidence and stuff, but this is just, the idea is that it's going to be higher. And we said even without supply disruptions, prices would go up anyway. So that's why in January we said, the market is favorable for hedging all of 26 to get rid of that risk. And right now it's just a matter of monitoring when the conflict ends, but then adding some months of the logistics domino effect before the whole thing is solved. Great. Simon, back to you.
Yeah, thank you, Tom. That's a fantastic glimpse of our forecasting data capacities there, and I appreciate the overview. We are running out of time, and we have been bombarded with questions. And just to reassure our audience, we will get back to you after this webinar with some answers. But to conclude, we could all recognize that the situation remains highly fluid. And I think it's fair to say that we are still in the early days of the crisis. That's why we urge you to stay connected with Expana for continuous coverage and actionable updates. We even launched a dedicated Middle East conflict section on the news page with insights and intelligence added in real time. So you can visit expanamarkets.com to learn how to access our premium market news, detailed data, and expert intelligence to guide your decision-making in these uncertain conditions. Thank you for joining us today, and we'll keep you informed as the situation evolves.